Prospect of jumbo interest rate hikes from the Fed alongside rising Treasury yields near 14-year highs cap the upside potential of the bullion. Furthermore, even though the yellow metal acts as an inflation hedge in times of economic uncertainty, the maintenance of the almighty dollar near 20-year highs seals away potential safe haven inflows from the precious. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook, and conclude with a technical analysis. The hotter than anticipated US CPI print essentially solidified the view that the Fed could march on with a jumbo 75 basis point rate hike in the September meeting. As the results pointed to an uptick of inflationary pressures, both on the month-on-month and on year-on-year basis. More specifically, the month-on-month CPI rate rose to 0.4% compared to the 0.2% estimation, recording a faster than anticipated rise, and the year-on-year CPI rate amounted to 8.2% compared to 8.1% estimates, signaling that inflationary pressures are not abating despite the radical pace the central bank has been raising rates. This, as a result, is expected to boost the dollar, as a consequence diminish overseas demand for the precious metal, making it more expensive for investment. All things considered, given the recent CPI results, the better-than-expected employment report results posted earlier in September, and the multiple of recent speeches from Fed policymakers reiterating the need for squashing inflation by keep hiking rates. We hold the view that the Fed will indeed move aggressively by hiking for 4 consecutive meetings with 75 basis points. Currently, the FFF implies a 91% probability for the central bank to proceed with a 75 basis points rate hike in their November meeting. Therefore, in our assessment, gold continues to be disproportionately predisposed towards the downside on a fundamental level, as the dollar continues to receive safe haven inflows, which tends to dampen the attractiveness of the shiny metal. There were no surprises as to the contents of the September's FOMC meeting minutes, where the unified view for restrictive policy was once again on display. The release showed that the Fed's policymakers were committed to raising interest rates to an acceptable level, waiting for clear indication that inflationary pressures are subsiding substantially, before considering slowing the pace of hikes. Data dependency was another key aspect cited, both in the meeting minutes and in various speeches delivered by policymakers, such as Fed's Vice Chair Brainard during the past week, but also the acknowledgement of the possibility that the central bank's aggressive intents can tip the economy in a recession by over-tightening. Moreover, also noteworthy was the dismissal of the idea for a premature pivot at this stage, which provided the dollar more support at the expense of the pressures. We would also like to point out the scheduled speeches from the Atlanta Fed President Bostic later today, tomorrow's speech by Minneapolis Fed President Kashkari, and later this week the speech participation from Chicago Fed President Evans, Philadelphia Fed President Harker, Fed Board Governor Jefferson, and lastly New York Fed President Williams, marking the end of FOMC speech cycle before the policymakers assemble for the earlier November meeting. Should the speeches continue to deliver the as-expected hawkish undertone, we would expect seeing further support for the dollar and gold to remain prone for downside movement due to their inherent negative correlation. Thank you for watching.